Welcome back. Following our previous conversations on the various nuances, aspects, elements of investment management, today we are going to dive deeper into portfolio management and construction. And thank you again, Amit, for joining us again today. And uh, and I know in the previous conversation we slightly touched upon this topic of the portfolio management and construction, but give us like a 50,000 feet view of what this overall intricate word of uh, portfolio management, construction, asset allocation, and so forth look like, and then we probably dive deeper into the more nuanced pieces of it.
Okay, thanks Ashutosh again. Yeah, portfolio management and construction. Now, this is, I think, the meat of the process, right? You've done all your research. Is now you actually want to invest into what you want to buy or sell, right? It's you go and buy the different kinds of assets. So this is really, as you say, where you actually money starts playing a role, right? So in a sense, people have been investing money for forever, right? There's always a desire in humankind to generate more returns. I think it's only about after 50s, in the mid 50s, where a more formal process of portfolio management and construction came into place. So we start with portfolio construction is nothing but uh, you want to create a portfolio of assets in which you have invested your money based on your investment objectives, right? You might be allocating money across various assets in a certain ratio depending on your risk return profile, and within those asset classes you might be further investing into specific securities that belong to that particular asset class. So there are multiple tools in constructing a portfolio, right? And then is the portfolio management aspect. It's almost like a continuous maintenance of the portfolio. If I take a very simple analogy, you construct a house. When you buy land, it's almost akin to portfolio construction. You look at various aspects, how much money you want to spend on building the house, what will be the size of the various rooms, how much money you want to spend on interiors or exteriors, on paint. So that's the initial layout that you will start building the house. And then over a period of time, you start need to maintain house. You might remove certain thing, you might add something more. So that is kind of the portfolio management aspect of it. But one thing I would like to emphasize is the whole aspect of portfolio management. The underlying concept behind this is risk management. All practically a fund manager or portfolio manager is continuously managing uh, investors' money. They're trying to manage risk, because risk return is a very underlying principle behind generating returns, right? Based on a certain investor desire to generate return and his risk profile, you allocate risk across various asset classes and construct the portfolio and then manage it.
So that's a quite a lot to take in. So maybe we'll start unpacking what you just spoke about around the construction management, risk management, asset allocation, and all of that. But before we go there, I remember in previous conversations you spoke about that portfolio management and construction is a bit, it's a bit of an art as well as a science. So help us understand which elements of these are more like scientific in nature, or say the sort of quantitative side of it, and how much of this is more of an art, or say the where the this kind of qualitative judgment is more important.
Okay. If I again bring the analogy of building a house, right? So the quantitative aspect of that is the science, where you will decide, okay, this is the amount I need to spend to buy the land. This is I will spend, say, on my furniture, on my interior, on the various aspects, what would be the size of the kitchen, the bedrooms, right? But then there is a qualitative aspect of it. Who would be the interior designer you will hire?
Hmm.
You will probably do a lot of research on that. And then the kind of designs
The
that you will
aesthetics,
create,
the colors,
right?
the
When you're building a kitchen, right? What's the kind of cooktop you will use? Does it add
yes,
any value? So that is the qualitative, where you do get your in-depth research, identifying the right
yes,
uh, say furniture or the item or which is best suited for you, and that enhances value. The same person might spend say 10 lakhs for building a house. You might also spend 10 lakhs,
hmm.
but you probably choose the right architect, the right designer. That much is increase your value of the house to 15 lakhs, so the other guy might just be 11 lakhs.
Okay. So for our viewers, especially who are not from the, maybe the core domain is not finance, how does this literally translate into, the equivalent aspects within the investment management world?
Okay, so I think we had talked about earlier as well. The quantitative aspect is when you create a mathematical model, right? You run numbers and you come out with something which says, okay, this should be the price. But then the qualitative aspect is and especially that comes in what we call as bottom-up research, right? Where you actually try and gauge the management which is running the company. Do they do what they say, right? So it is that in-depth research and that ability to gauge the quality of the management, right?
Right.
I think that is a very key aspect, and that is where your intuition or whatever that all that brain power comes in, because ultimately companies are run by people, and if they do it the right way, they do what they are saying, they report their results in the right way, being transparent. I think that is where.
And when a while back you were talking, you spoke about the another important element of this being risk. Now, it seems like on one hand you're trying to sort of manage the risk, but on the other hand, because you're in this area, you also core objective is to maximize returns. So where does that balance lie, in this whole portfolio management construction theory between two, because they sound contradictory?
Okay. So everybody wants to have maximum returns with minimum risk, right? But I don't think there is any asset class where you can achieve both. You can either minimize your risk for a particular set of return you want, or you can maximize your return for an amount of risk you can take. It is not mathematically possible to achieve minimum risk and maximum return. I think there's no asset class anywhere you can achieve that.
Yeah.
I think formally all of these concepts came in sometime in 15 when the modern portfolio theory by Harry Markowitz was announced, where he first tried to scientifically understand how do our markets behave. You would have earned, if you're a mathematics student, right, you would have the concept of standard deviation and mean, right? So in a very simple language, mean is the return you get and standard deviation gives you the risk you're carrying on the portfolio.
Yeah.
Right? So higher the standard deviation, higher the risk and more chance you get a higher return. So it's, in a very simple layman language, return is the amount of return, the money you're generating on the investment, and risk is the volatility of that return.
Right. So tell us about, what would be the steps involved on the ground from a portfolio construction standpoint, because we spoke about, with the processes, and there's a need to balance this with risk, and by maybe investing in different asset classes and so on. But what are literally the steps, if you could lay out that for the audience?
Yeah, Santosh. So I'll probably take this whole question from a view of an asset management company which is managing money for multiple clients, or for a hedge fund which is again managing money. So the very first step in portfolio construction is to define the investment objective, right? From an investor's perspective, what do they want? Do they want capital growth with minimal risk? Do they want a regular income, or do they want something, a very high return, but they're willing to take a risk? So I think that is the very first step. You first need to define what is the investment objective, why somebody is giving money for you to invest, and probably convert that into some kind of a mathematical formulation. Right. And then you understand what is the kind of capital you're going to get. Based on those two, and based on the investment objective, start defining your asset allocation strategy. Right. So somebody who may want a very high kind of return might allocate more to equity, less to fixed income, and maybe very minimal to, say, real estate. Somebody who wants a very stable return, he might want more high on the fixed income side, maybe even some part of real estate which gives them a regular income, and an equity which gives some capital growth. So that you first define the asset allocation strategy. Asset management firms also typically tend to also follow a benchmark. So suppose it's a fund mandate is only invest into, say, Indian equity, they may follow the BSE 500 as a benchmark, and that helps them do their allocation across securities.
Okay. So one aspect of this is whether I'm going to be more risk averse or whether I'm willing to take more risk, and depending upon that, what asset classes I want to go after. And then the other part of this you're saying is that in terms of measuring, then you're saying, what do I compare it with
Yeah, because
to?
again, it depends on what kind of product it is.
Hmm.
Some products are benchmarked against a particular index. Somewhere is more of a, typically in hedge funds you specifically define the return. I think another key parameter to look for this is the tenure of the investment.
Hmm.
How quick your investor, or do they have a short term view or a medium or a long term? That also kind of defines your asset class strategy,
Okay.
right? So once you have defined your asset allocation, the next step is security selection.
Hmm.
So typically, most portfolio managers do a combination of a top down and what we call as a bottom up. From a top down, they'll start with a broad set of security. They will apply some filters and screens based on which they will say narrow down a universe of 5,000
And
securities.
just for the sake of our audience who's probably not from a core finance background, by security you means like the kind of financial instruments that somebody
Yeah,
is buying, like stocks and
yeah.
bonds
So
and
security is anything which has a value and which can be traded. It
right,
doesn't just need to be a financial instrument. It
right,
could even be a painting, it could even
or
be a
real estate
house,
or
it could be
crypto,
anything. So
right?
anything which has a value and it has a market
Yeah.
becomes a security.
Okay.
So suppose we've narrowed down, we want to invest, say, one of the asset classes is Indian equities, right?
Mm.
You probably take BSE universe of securities, you apply certain filters. Okay, I want to invest into stocks which have a certain PE ratio, only below that, or certain market cap because of liquidity reasons. And there are a lot of ways fund managers operate, the way kind of screens or filters that they apply, almost like a funnel, and you come out with a list of what they call as their investable universe. And then typically they will do a bottom up research on that investable universe, which we have talked about in the research sessions earlier, right? And then they come out with a list of stocks in which they will start investing. Typically, most of the investment gurus say a typical portfolio which can give you a diversified portfolio manages risk about 30 to 40 companies,
Mm.
especially in the equity world, can give you a well diversified portfolio which can maximize your returns in terms of the risk involved as well. So
Right.
once you have constructed the portfolio, next step is to start allocating real money, and then you send out those orders to the trading desk.
Very interesting. And we spoke about the risk management side of it as well, and you were talking about investing in different kind of asset classes to kind of manage some of that risk. But let's say if I'm very heavily invested in equities, I'm in my, let's say, early 30s, late 20s, very heavy equity portfolio, retail investor, then what does diversification mean in terms of when I'm operating within an asset class? Is there a concept like this? How does that work?
Yeah, in fact, diversification you can do within an asset class, but that is one of the most frequent use cases. You typically invest in securities which uh, may not have a complete correlation, right? You don't want to have a portfolio of 40 stock where everything goes ahead and goes down at the same time, right? So we have this concept of one of the key aspects of risk, portfolio construction, as I talked about earlier, risk management, right? And there are two kinds of risk: systematic risk and unsystematic risk. Systematic risk essentially says, it typically defines a portfolio, the market risk that you carry, right? When COVID-19 happened, the whole of the market went down.
Mm.
You probably didn't have much control. But unsystematic risk is something which is is a risk associated with returns of a specific company.
Mm.
So and so then you start taking securities in a portfolio which tend to have, say, opposite correlations with each other. You can't manage systematic risk with that, but unsystematic risk can definitely be managed by diversification.
Mm.
And typically, portfolio theory says if you have constructed a well constructed portfolio of about 30 stocks,
Mm.
you can achieve diversification. When I say 30 stocks, it doesn't mean all 30 stocks are in technology sector.
Right.
Because so when the technology sector goes down, everything goes down.
Yes.
Although people might say technology sector has been outperforming the last 5 years,
Yeah.
but you never know.
Yeah, I was looking at something up on the internet yesterday. It seems like the last year, technology sector's kind of been in a bit of a
But yeah,
decline.
if you remember the dot-com crisis in
Yes,
2000, 2001, every dot-com company got boomed, right? They were generating
yes,
100% return, more than 100%,
yes,
but suddenly everything.
yes,
So I think it has to be a combination of sectors. Some investor gurus say just go and buy an index fund,
yeah,
right? Passive investing is the right way, especially for defensive investors who don't want to take a lot of risk,
yeah,
because an index fund gives you a diversification across all securities in that index, right? You automatically achieve diversification,
yeah,
and you also pay very minimal fees.
yes,
But yeah, it's again up to you. But if you go for active investment, there is a chance you will beat the benchmark.
yeah.
I personally have invested a lot through active funds, but yeah, active funds historically it has also been proven not more than 10% of active managers are able to beat the benchmark.
Fair enough. Okay, so I think a little bit when you were speaking about, seemed like you were touching upon this whole cyclic, or let's say the changing patterns over a period of time. So with the advent of AI, ML, deep learning, all of that. Prior to this, a lot of mathematical models evolving, and then if you further go back, hopefully when there were no internet days, what have been the key milestones in this investment management landscape, and how this has evolved over a period
Okay,
of time?
so I think somewhere till about the mid 40s, there was no formal uh, really fund management. I think some of the big fund management companies started somewhere in US in 1940s after the depression, but before that it was very unstructured, right? There was no science. People just used to buy stocks based on what some others are saying. I think when first the modern portfolio theory and those CAPM models came in, people started doing research, and some more kind of academic research uh, went behind generating portfolios. That it led to the advent of active management. But the whole in 50s, the whole when these theories came in, it was based on the underlying principle was that markets are rational and
Hmm.
all information is available,
Hmm.
right? And every
Yeah.
investor is a rational investor.
Yeah.
So, but yeah, you had some theory, and then it started getting further evolved. With active managers came in, they said markets are not rational. We can't make money because of stupidity of others.
Hmm.
And then somewhere in 70s came the idea of passive investing with firms like Vanguard, which started launch with who said this active fund managers, they're not able to beat the benchmark, but they still charge you very heavy fees. So passive fund management came in very heavily somewhere in mid 70s, which also led to the advent of technology because passive fund management relies a lot on technology.
Right. Right.
And then as things evolved, I think when further research started coming in, one of the key concepts which came in was behavioral finance.
Hmm.
Then you would have heard of behavioral scientists like Daniel Kahneman and Richard Thaler, who understood research on the psychology of the investors,
Hmm.
who brought the psychological sciences into finance, and they started uncovering biases
Right.
when you invest. So a very common bias is confirmation bias,
Hmm.
right? Where you say you've invested into a particular company and you receive negative news about that company. Because you have invested a lot, you'll probably ignore that news and try to rationalize your investment.
Yes.
And the other says something like loss aversion.
Hmm.
So say you gain $100 in investment, you will feel some happiness. But if you lose the same $100, you will see twice the unhappiness.
Right.
So
Right. Right.
people, investors don't tend to sell when they're making a loss because they
Right.
don't want to experience an unhappiness. Even
Hmm.
though so these kind of theories have started coming in, we started influencing again the way investors invest. In between, so there are a lot of now studies which are done, and people are fund managers are being evaluated on their biases. In between, in parallel, they also started a movement of quantitative portfolio management,
Right.
which completely relied on technology, uh, processing huge amounts of data, and uncovering data patterns. And in fact, they hired people who didn't even have finance background. They hired physicists, mathematicians who were very good
Right.
at processing data, uncovering patterns, and doing programming. People like Jim Simmons of Renaissance Technologies. One of the reason they say those funds are successful is because there's no emotion.
Right.
You're
Yes.
practically running
And we
everything.
spoke about in one of the previous videos, and for the listeners, if you haven't checked out those previous conversations, we dived a little bit more deeper into the research management side of it, which is like a precursor to before you start calling the shots on what to invest on. So
Yeah.
please go back and check
And
those
now I
videos.
think it's finally led to the AI
Yes.
revolution, which is hitting us. I think it's still ongoing. People are still trying to see whether we can completely allow AI to run our money.
Yes.
One of the big drawbacks, at least I feel, is most of the current uh, AI algorithms or like neural networks,
Yes.
they are very black box in nature.
Yes.
You can't explain the output based on the inputs that have been given.
Yeah.
And I'm not sure if as an investor is
Yeah.
that something you will like, or even the regulators. So I think
So if the inherent biases are built into the model, then you probably just suffer the
yeah.
consequences.
And you can't even explain why it
Yes.
happened, right? Like even with active management, fund managers go through a review process regularly with their CIOs. There is a portfolio charter again, which they are evaluated, things like Sharpe ratios and all of those.
Yeah.
There are still some numbers, but AI at the moment I think it's way too black box, difficult to unearth. But you never know. As things evolve, you might get fund managers might become redundant.
Interesting. You spoke about the CAPM, capital asset pricing model, and the modern portfolio theories, which hopefully help investors to make better decisions. But for our viewers who are not from who do not understand financial theories, can you explain in very simple terms what these concepts are to our listeners?
Okay, so like I explained earlier, modern portfolio theory or the first attempt to understand uh, this whole concept of risk return, right? So risk, you do any activity, there's a risk to it, right? There's hardly anything where you'll have zero risk, right? So you just try to measure the risk on something you invested. So risk is the variability of your return. So suppose my portfolio is returning me 5% annually as my annualized return over a period of 10 years, but it could have varied from 10% in 1 year to 2% in another year. So modern portfolio theory tries to measure that risk and says, okay, you can diversify your portfolio to minimize that risk, right? So essentially, standard deviation versus divided by the return. When the CAPM model came in, and there were further studies which have been going on risk. So I think I referred to earlier as systematic risk and unsystematic risk. Unsystematic risk is when you want to manage the risk of returns of a particular company, and then you diversify it to manage that. Systematic risk is something measured by a concept called beta. Right? You measure the correlation between the returns on your portfolio to that of the whole market. So capital asset pricing model tried to bring both of these concepts together to give a mathematical formula of how do you calculate returns on any particular portfolio. So they assume that there's something called a risk-free return. It is generally, say the US government issues treasury bills, which is always guaranteed, 100% guaranteed by the government. So that gives you the risk-free return, right? So you'll always get 3% return, say, on treasury portfolio. Any other investment you want to make, you will at least want to earn more than this 3%, right?
Yeah.
Because that is where alpha or a portfolio managers or my own skill comes in as an investor.
Right.
So CAPM model tries to bring these 2-3 concepts together. The relation between my portfolio to the market, the total returns I am making on my portfolio, and the risk-free rate. So in a way, it tries to bring out, okay, say the markets will go by 5%. How much will your portfolio go up or down? And also tries to give you a measure of how much value add, say a fund manager whom I am paying fees is adding.
It's very interesting. I was listening to one of the, I can't remember what it was, podcast or something on YouTube, and somebody was interviewing Vishy Anand, who's a great grandmaster chess player. Everybody knows him. And he was asked this question that, because the kind of computational natural power that he has, he's saying, when you're trying to plan for events or anything in life, do you tend to go through like these 100,000 calculations in your head and come up with the right answer versus you're just maybe sometimes impulsive and take just out of gut or whatever that might be, you take those decisions. Do you think in real world these kind of things happen, that although there are so many theories like CAPM and these everything else that you spoke about, so much that can happen from a risk front and benchmarking and whatnot, but still sometimes people could take.
Yeah, like I think earlier I spoke about this whole behavioral biases, right? All of these theories were built on the assumption that all investors are rational and every information is available, which is not the
Right.
case, right?
Right.
Every human being has their own neural network, the way it operates, the way it interprets information,
Yeah.
and investors are also humans, right?
Yes.
So the way you interpret information would be very different from the way I will.
Yes.
Even if I am giving the same data, the same annual statements,
Yeah.
and then you arrive at a decision. There's certain people. So if you heard of this concept of thinking fast and slow,
Yes.
right?
Daniel Kahneman.
Daniel Kahneman.
Yes.
So he's the guy who first brought behavioral finance into practice. So a lot of people, I think a majority of investors still operate in that fast mode where they
Yes.
tend to invest based on their intuition.
Right.
And
Right.
it has been proven retail investors don't make money in the market.
Other than I was seeing this wonderful movie, I strongly recommend watching it. I think it's called Dumb Money or something like that on Netflix. There was a guy who was trying to influence this. What was the name of the stock? GameStop or something, where he was trying to, the hedge fund manager was trying to break the backbone of the stock by, going short, and then he was kind of influencing the retail investors to hold the stock, and then it totally brought some of the hedge funds on the verge of a crisis. Interesting movie.
But that doesn't mean also the professional investors like fund managers will also give you return beating the benchmark. So it's
Fair
a very
enough.
murky world. I think as an individual investor, if you are really think you can make money, then it's a full-time job. I think a lot of people tend to invest, especially retail investors, as more like a part-time hobby, but it doesn't always generate.
So I think that's a brilliant point that you bring up, and I think we were speaking about this earlier offline as well. I think maybe we should do a short video of saying, these are the kind of things that retail investors do. So for example, I was speaking to my sister the other day. She bought a stock, and she said, if it goes down, then I'll just hold. So these kind of behaviors that you tend to see, applying this kind of, the commonsensical approach to sort of solve these specific problems, which doesn't necessarily work.
Read about some of the biggest investors who started individually, Warren Buffett and those guys of the world. I don't think they trade very frequently.
Yeah.
They'll hardly do 5 or 6 trades in a year.
Yeah, that hole in a punch card theory that Warren Buffett
all
had.
the time they spend is on reading about those companies, doing research on what is the right. I mean, and there is a big difference between a trader and investor.
Yes.
A trader will just buy and sell.
Yes.
Maybe even 10 times a day. An investor will always invest money for the long term.
Right. So from investor standpoint, he's kind of buying the company rather than catching on to the price movement in a very tactical way. Interesting. So I think we spoke about so much about all the scientific approach that sits behind this concept of portfolio management construction. But then what could go wrong? So talk a little bit about the challenges that one might face in the portfolio management construction world or the framework.
Okay, I think one thing is you've heard of black swan events, right?
Yes.
There was this
Nicholas Nassim Taleb. Yeah.
Many of these theories are built on this whole normal distribution, which goes plus minus 3 sigma.
Yeah.
The black swan events happen on the tails,
Yes.
which theories just kind of ignore that they will never happen. COVID-19 happened.
Yes.
Nobody could predict. A lot of people lost money as well.
Yes.
Right. Suddenly a research report comes in out of the blue which says this company is great, right? I don't know what is the motivation behind it. Report goes out on social media, everybody goes and buys.
Yeah.
And then you find suddenly there was this whole game being played where people are just pushing the stock, and ultimately what happens is the people who came in at the end to buy the stock, and those are essentially laymen and retail investors who enter the market at the end, they suffer.
Yes.
You have seen a lot of companies which just went bankrupt in a day. Just because I think it's when you're investing, I think people also need to understand. I think there's another a fallacy that has built within the investing world that equities are good and bonds are bad. because they don't give you return. But
Hmm.
I think you need to understand that bonds or fixed income uh, gives you that foundation on which you can take the risk of investing in equity.
Yeah.
Right? It's
Breaks let you go faster.
right. You are an agile coach, so you understand. So I think we need to understand that every asset class has its value. You need to diversify. Don't put all your eggs in one basket.
Yeah.
I think
Yeah.
that is one thing which especially retail investors miss out. They tend to follow a herd mentality.
Hmm.
At the moment, stocks are rising, so everybody's has
Yes.
put all their money into stocks.
Yes.
But you never know when this whole party will end. Then
Yeah.
it's a fixed deposit in your bank, which will actually help you do your
All
daily
the
chores.
demons will start coming out. So that's very interesting, Amit. I think I'm just being conscious of your time as well. And I know we have a limited time today. But I think one of the things that I'm thinking, hopefully, because we spoke about portfolio construction, management, asset allocation, some of the, this theories that sit behind it and all of that. Is talking about risk the right kind of a next logical segue into continuing this conversation? Uh, because there's a lot that we can cover, but I'm thinking that from there maybe the next conversation for our audience could be a little bit more focused around
Yeah, I
risk.
think because risk is the underlying principle behind all portfolio management, because that is what fund manager trying to do, manage risk on behalf of their investors, and that is almost all theories talk about it. So yeah, it could be a very good topic for us to understand.
Brilliant. So on that note, I think the next topic coming up for you guys, we'll plan it in the coming week or so, is will be around the risk management of the portfolio. And thank you very much, Amit, for doing this again. And you guys stay tuned, and we'll see you again next week. Thank you.
Thank